Freddie Mac reports are more than just eye-opening. They're a wake-up call. Well, have you ever stopped to think about what happens when the very people who own our apartments can't make ends meet? It's happening right now. Freddie Mac has just dropped a bombshell report revealing a record spike in mortgage defaults among landlords. We're not talking about small change. We're seeing defaults hitting levels not seen in years. Specifically in the last quarter alone, defaults soared by an astounding 20% compared to the same period last year. That's thousands of property owners struggling to keep the lights on. Now, you might be wondering, okay, but how does this affect me? Here's the lowdown. As more landlords find themselves unable to pay their mortgages, we've seen a corresponding rise in apartment vacancies. Vacancy rates have shot up to 15%, the highest in over a decade. The glut of empty apartments is putting pressure on rents, leading to something renters haven't seen in a while: falling rent prices. Yes, after skyrocketing by over 30% during the pandemic, rents are finally beginning to dip. But let's put things into perspective. While rent prices soared, wages for most people only nudged up by about 5% during the same time. This disparity has left many renters stretched thin, struggling to cover rent that eats up a larger chunk of their paycheck. The consequences of this shift are significant. With landlords defaulting at such a rate, the ripple effects are felt far and wide, from the stability of the housing market to the affordability of renting. But what's driving this unprecedented situation, and what could it mean for the future of renting and home ownership? As we dive deeper into this topic, we'll explore the roots of these changes and what they signal for the housing market and for all of us looking for a place to call home. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Did you know that before this wave of defaults, the housing market looked a lot different? Let's take a journey back in time and see just how dramatic these changes are, with numbers that paint a vivid picture. First off, Freddie Mac isn't just any company. It's a powerhouse in the U.S. housing market, ensuring that millions of Americans have access to affordable housing. But even powerhouses feel the tremors of economic shifts. So how bad has it gotten? Let's dive into the stats and see the transformation. Pre-pandemic, the default rate among landlords was around a manageable 1 to 2%. Fast forward to today, and we're seeing figures that have jumped exponentially, reaching upwards of 20% in some areas. This isn't just a small bump in the road, it's a mountain that's appeared seemingly overnight. And let's talk about vacancies. Before the world turned upside down, vacancy rates were at a steady 5%, reflecting a healthy demand for housing. Now, they're tripled to 15%. A clear sign of the times. But here's where it gets interesting. Despite this surge in empty apartments, rents had previously been on an unstoppable rise, increasing by over 30% during the pandemic, far outstripping wage growth, which barely budged at 5%. Comparing this situation to 5 years ago, the average rent for a one-bedroom apartment has skyrocketed from $1,000 to $1,300 in many cities. While average wages, they've gone from $50,000 to just $52,500 annually for many workers. This disparity has pushed the envelope, leading to the current crunch. To put that into perspective, if you're making $50,000 a year before the pandemic and saw a 5% wage increase, you'd now be earning $52,500. But if your rent was $1,000 a month and jumped 30%, you'd be paying $1,300 a month. That's an extra $3,600 a year out of your pocket on rent alone. But it gets more concerning. A recent study highlighted that over 50% of renters are now spending more than 30% of their income on rent, with a significant portion allocating over 50% of their earnings to cover housing costs. Financial experts often warn that spending more than 30% can lead to financial stress. Yet here we are, with the average renter facing numbers well above that threshold. This disparity isn't just a strain on individual budgets, it's reshaping the housing market and changing how we think about affordability and living standards. As rent prices outpace wages, more people find themselves making tough choices, cutting back on essentials, or moving to less expensive areas. But what about Freddie Mac's role in all of this? Pre-pandemic, they facilitated the financing of hundreds of thousands of mortgages, keeping the market fluid and accessible. Now they're scrambling to address the default crisis, implementing programs aimed at providing relief to landlords and tenants alike. So as we piece together this puzzle, the numbers tell a stark story, from stable, low default rates and vacancies to a world where both have spiked, shaking the very foundation of the housing market. Ever stop to think about the domino effect in the real world? What happens when one piece falls, like landlords defaulting on their mortgages in record numbers? The consequences ripple through the housing market, touching lives far and wide. When landlords can't make their mortgage payments, the immediate reaction isn't just a financial blip on a spreadsheet. It's a wave that washes over the entire housing market. Recent reports show a staggering 20% increase in mortgage defaults among landlords compared to last year. This isn't just about a few properties, it represents thousands of rental units across the country. But here's where the numbers start to get really interesting. With these defaults, we're seeing a 15% spike in apartment vacancies. This might sound like good news for renters at first glance. More options and lower prices, right? Well, it's not that simple. While rents have indeed started to drop, with some areas seeing reductions of up to 10%, the long-term outlook isn't as rosy. When properties go into foreclosure, it impacts the availability and quality of affordable housing overall. In the past year, we've seen a 5% decrease in the number of available rental units, directly tied to these defaults. And with fewer options on the market, those in search of affordable housing are finding it harder than ever to find a place to call home. The economic ripple extends beyond just renters and landlords. Local economies suffer as property values dip in response to increased foreclosures and vacancies. For every percentage point increase in landlord defaults, we see a corresponding 0.5% drop in local property values. This affects homeowners too, not just those renting out properties. And let's not forget about the job market. The housing sector employs millions, from construction workers to real estate agents. With the downturn in the housing market, we're seeing a slowdown in new construction projects and a tightening of the job market in these sectors, with a 10% decrease in housing-related employment. The big picture? This chain reaction, triggered by rising landlord mortgage defaults, has far-reaching implications, affecting not just the housing market but the broader economy. Renters find themselves caught between rising prices and decreasing availability. Landlords face financial ruin, and the local economy braces for the impact. Feeling the pinch every time rents do? You're not alone. But imagine a world where rents are dropping. Sounds like a dream, right? Well, hold that thought, because while lower rents might seem like a win for renters, they come with a hidden catch. In recent months, we've witnessed an unusual trend. Rents are decreasing for the first time in years. Reports indicate a 5 to 10% drop in rental prices across major cities. On the surface, this is great news for renters who've been battling rent hikes that far outpaced wage increases, but here's where the plot thickens. While rents are going down, the quality and availability of housing might also take a hit. How so? With a 20% increase in landlord mortgage defaults, many properties are at risk of falling into disrepair or being sold off. This isn't just speculation. Data shows a 30% decrease in maintenance and upgrades on rental properties over the past year. Landlords, strapped for cash, are cutting corners wherever they can. A decrease in rental income can lead landlords to exit the market altogether. This has been evidenced by a 15% reduction in the number of rental units available on the market compared to 2 years ago. Fewer rental options mean less competition, which can eventually lead to a spike in rents again once the economy stabilizes. Now, let's talk about the potential long-term effects. The current trend could discourage investment in new rental properties. With the construction of new apartments slowing down, a 25% decrease in building permits for multifamily units this year, future renters may face a scarcity of options. This scarcity could reverse the current trend of falling rents, pushing prices even higher than before. So what's the takeaway? While the current drop in rents might offer some immediate relief, the underlying issues in the housing market pose significant challenges. Without strategic intervention and support for both renters and landlords, we could see a cycle of volatility that makes affordable housing even more elusive. Ever wonder how big of an impact government actions and private sector initiatives can have during a crisis? Let's see how efforts to tackle the rising issue of landlord mortgage defaults and housing instability are playing out. In response to the surge in mortgage defaults, which have skyrocketed by 20% in the last year alone, Freddie Mac and other entities have rolled out several measures aimed at stabilizing the market. For starters, Freddie Mac introduced a program that offers landlords mortgage forbearance, provided they don't evict tenants struggling to pay rent. Since its inception, this program has seen enrollment from landlords representing over 500,000 rental units. That's 500,000 households given a fighting chance to stay in their homes during tough times. The federal government stepped in with a rental assistance fund totaling $45 billion, aiming to cover back rent and prevent evictions. To date, this initiative has dispersed funds to approximately 420,000 renters, injecting much-needed liquidity into the rental market and giving both tenants and landlords a financial lifeline. On the private sector front, major real estate investment trusts, REITs, and housing nonprofits have launched their own relief efforts. One notable initiative is a $100 million fund designed to offer zero-interest loans to small landlords, on the condition that they keep rents stable and maintain their properties. So far, this fund has aided over 1,000 landlords, indirectly benefiting around 250,000 tenants. The numbers are promising, but the question remains, are these measures enough to turn the tide? While the immediate effects offer some relief, with evictions down by 10% compared to pre-pandemic levels, and maintenance of rental units slowly picking up, the long-term outlook is still uncertain. The key will be ongoing support and adaptability in these programs to meet the evolving needs of both renters and landlords. As we look ahead, it's clear that collaboration between the government, private sector, and communities will be crucial in navigating the challenges of the housing market. And remember, knowledge is power. Staying informed about these initiatives and how they impact you is the first step toward making a difference. Curious about what the future holds for the rental market? With all the changes we've seen, everyone's wondering where we go from here. First off, experts forecast that while we may see a temporary dip in rental prices, averaging a 5% decrease across major cities, this trend is expected to reverse within the next 18 to 24 months. Why? The demand for rental units is projected to surge, driven by a recovering economy and an increase in employment rates. With job growth anticipated to rise by 10% in the coming year, more people will be looking for places to live, pushing rental demand up. Now let's talk about supply. Remember the slowdown in construction we mentioned earlier? Well, it's set to have a long-term impact. New housing starts are currently 25% lower than pre-pandemic levels, and it's going to take time to catch up. Experts predict a shortfall of nearly 500,000 rental units by the end of next year, which could tighten the market further and potentially lead to an increase in rents. But there is a silver lining. The crisis has sparked innovation within the housing sector. The rise in defaults and the subsequent government and private sector responses have heightened the need for more sustainable housing solutions. As a result, we're seeing a push towards affordable housing projects, with an estimated 200,000 units set to be developed over the next 5 years. Moreover, the market is also witnessing a shift in preferences. The pandemic has altered what people want from their living spaces. Demand for units with home offices, green spaces, and amenities conducive to remote work is on the rise. This shift is prompting landlords and developers to rethink their offerings, potentially leading to a more diverse and renter-friendly market. So what does all of this mean for you? If you're a renter, the next couple of years might present new opportunities and challenges. Rents may fluctuate, but the push toward innovation could result in better living conditions and more choices. For landlords, staying adaptable and responsive to market changes will be key to navigating the future successfully. The rental market is at a crossroads, and the decisions made now will shape its future. Staying informed and engaged is crucial, whether you're renting, leasing, or just watching the market. Are you navigating the tricky waters of the rental market, trying to figure out your next move? Whether you're on the hunt for a new place or aiming to fill one, the current landscape can seem a bit like a maze. But fear not, we've lined up some key advice backed by the latest numbers to help guide your way. For those of you looking for a new spot to call home, now's the time to widen your search. With vacancy rates soaring to 15%, more options are out there waiting for you, possibly in neighborhoods you hadn't considered before. And here's a pro tip: the market's shifting, and with rents dropping by an average 5 to 10% across many cities, your negotiation game could really pay off. Bring your research to the table, showing that nearby rents have dipped gives you solid ground to ask for a lower rate. Plus, don't overlook the potential of signing on for the long haul. Opting for a lease longer than the typical 12 months might just land you a deal, with some landlords willing to knock off up to 5% per month for the security of a longer-term tenant. Now, for the landlords out there, flexibility is your friend in times like these. Considering the market trends, adjusting your rent expectations down by 5 to 10% could make the difference between an occupied property and an empty one. And though it might be tempting to cut corners on property maintenance to save a few bucks, remember, a well-kept property is more likely to attract and retain tenants. In a market where maintenance and upgrades have dropped by 30%, those who invest in their properties will stand out from the crowd. Also, don't forget about rental assistance programs. With the government rolling out over $45 billion in aid, encouraging your tenants to apply not only helps them, but ensures your cash flow remains steady. Whether you're searching for the perfect place to live or looking to fill your rental, navigating today's market is all about being informed, flexible, and ready to adapt. By understanding the current trends and applying some strategic thinking, there are opportunities to be seized. That brings us to the end of the video. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.